Hi, everyone. My name is Marcos Lemus. I'm a financial advisor here at Bulman Wealth Group, and I wanted to jump on here to briefly discuss something that's in the news in front of mind for everyone, the 2025 tax bill, otherwise known as the One Big Beautiful Bill. Now, there's certainly way too much to cover in this bill to fit it into a short video, but I did want to make sure that we were touching on some of the things that are maybe new additions and extensions of current parts of the previous tax bill. I will say before we begin, I always recommend consulting a tax professional or a CPA when it comes to your specific tax situation. So let's get into this. This first section is income tax brackets. So in 2025, moving forward, we've got these tax brackets that will remain in effect indefinitely unless some future legislation changes these tax brackets again. But these are the current tax brackets that we're operating under now and have been for the last 8 years. So the 10%, 12%, 22, 24, 32%, 35, and 37% will continue to be the brackets going forward. As you can see here, you can pause the video and take a look at what your tax bracket looks like if you're a single filer versus married filing jointly, a head of household, etc. Then we move on to the standard deduction. So previously the standard deduction was lower, 14,000 and some change, and now it's increased for a single filer to $15,750. Meaning, if you're a married couple, we double that, and we're at $31,500. You can lower your taxable income via the standard deduction, assuming that you don't file itemized deductions. This is a great way for us to increase the standard deductions and something we'll look forward to slowly increasing as well. There's also a new senior deduction, and this does have an expiration date. This ends in 2028, but for the next few years, any seniors that are age 65 or older can claim an additional $6,000 per individual. So if you're a married couple, on top of the standard deduction, you can also decrease your taxable income by $12,000. This does begin to phase out. If you make too much money, you can slowly get phased out of this new senior deduction. And the deduction works as follows. It'll get reduced by $100 for every $1,000 over that modified adjusted gross income threshold. We've got the thresholds here for you. So if you're a single individual making more than $75,000 adjusted gross income, that's going to get slowly decreased if you make more than that. And same for joint filers as well. That threshold is $150,000. Now we've got these baby bond investment accounts, otherwise known as Trump accounts. Now these are free $1,000, essentially the government funded $1,000 that gets given to babies that are born between 2025 and 2028. Now any parents or legal guardians can help this account grow by contributing up to a maximum of $5,000. The benefit is this gets to grow tax-free, similar to an IRA or tax-deferred account. It does have some qualifying benefits as far as withdrawals, and there's a tiered system. So you can withdraw portions of this at age 18 and age 25, and then fully deplete it at age 30. But along the way, you can take qualified withdrawals as long as they're for specific qualified reasons, such as education, a home purchase, starting a small business, and there's certain benefits to doing that there. And these are taxed a little bit differently. So it's important to take a look at this if you qualify or your child qualifies to receive a baby bond account. Ask your financial advisor. It can certainly help with some of the long-term planning and then what those withdrawals look like and how the taxes work. And then lastly, child tax credit. This is changing, even if just slightly. It is increasing to $2,200 from the previous $2,000. So any child under the age of 17, any minor, you can get a tax deduction of $2,200 per child. And this is indexed for inflation, so this will continue to go up and increase starting next year and beyond. Now, of course, for this, there is also a phase-out threshold as well, so you could potentially earn too much money to where the child tax credit does not give you any benefits. But those thresholds today are $200,000 for a single filer and $400,000 for folks married filing jointly. So every $1,000 you make above those respective thresholds, your credit is reduced by $50. So it's possible to make too much and phase yourself out completely from this tax credit. But it is worth noting that there are some new changes, some continuations to current structure of our taxes via those tax brackets. And this is something that we'll want to continue to monitor. But I know there's a lot that goes into this bill, and we'll have some more to share in the future, but it's certainly too much to fit into a short video. So I hope you learned something. If you have any questions, feel welcome to reach out to your advisor or contact us here at Bulman Wealth Group. Happy to help. All right, until next time, take care.